Hi everyone, this is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. I've been following his work on Twitter. He has great tweets. So if at the end of this interview, I'll let him plug his Twitter. He's managed money for over 20 years. He co-founded a multi-billion-dollar hedge fund. He's the founder, editor, and publisher of the Felder Report. And he's the host of the Super Investors and the Art of Worldly Wisdom podcast. I'm surprised I actually got that right on the first try. Jesse Felder, thank you for joining me.
Hey, thanks for having me, Jason.
Now, Jesse, since you manage money, I'd like to get your perspective on this. So why do you think respected money managers with good long-term track records like Hugh, Hendry, and David Einhorn have either had to close down their funds recently or having record amounts of withdrawals? And Einhorn has actually been making money, right? So it's kind of surprising that there's record amounts of withdrawals. And then second part of the question, and I'm sure this will tie in, do you think then that one of the main reasons is because you're struggling to adapt to the rapidly changing global macro picture because of what the central banks have done? Or do you think that there's other factors involved, like how passive investing and exchange traded funds have become extremely popular now?
Yeah, I think the latter part of your question is really what gets at it. I have a great deal of respect for both those guys, and I think they haven't changed their process and the processes, and they shouldn't, because they employ the type of process that should work across full market cycles through many cycles. I think the hardest thing that I found about managing money is trying to get people to do the right thing at the right time, right? The time to really, buy stocks, in the last 20 years. I mean, March 2009 was a wonderful time to be a buyer of stocks, and I wrote, some bullish editorials and blog posts and things, and nobody wanted to hear it, right? It's just, probably a better example is, Buffett wrote a great editorial in late in 2008 in the New York Times. I think he called it "Buy America" or something like that. And when people should be buying stocks, it's really, really hard to get them to be bullish. Now, 10 years later, after one of the strongest and longest bull markets in history, it's really, really difficult to convince people that they should have some type of downside protection or some type of balance hedge in their portfolio right now, because over the past however many years they've done so well being long only that, hey, why do I want to curtail that performance at all, by putting on hedges when they just cost me money? And so, that I think is really the really difficult part about raising money for a fund, because right now it's just my opinion that we're going to have some great opportunities on the short side in the coming years. But if you tried to raise money for a short only fund, good luck with that. Nobody has any interest. And so I think that's why those guys are struggling, is not so much their returns have been poor, like you mentioned, but that, if they're not capturing 100% of what the S&P is doing, investors are bailing.
That's a good point. And there seems to, if you talk with value investors, they say, like you said, over a full cycle, a lot of them will say value investing works because over short periods of time, it doesn't work. So value investors tend to be more contrarian. But what we've seen is that there's this mindset now for a lot of professionals with the high frequency trading computers and the trend traders and the momentum guys that they're going to buy high and sell higher. And a lot of people don't really pay that much attention to valuations anymore as long as the chart looks good.
Yeah, exactly. I mean, there's, a whole, and this is really no different. I mean, every cycle is different in its own ways, but, people speculate in a bull market. Prices do well, and greed is, a natural human instinct, and so speculation becomes, more and more popular as the bull market goes on, and so, yeah, people abandon, an investment discipline that requires some type of, value-conscious approach for other things that are just, momentum or what have you.
So I want to dig a little bit deeper on passive investing in these exchange traded funds. We almost had the volatility, the VIX ETFs blow up. They were leveraged. I mean, retail probably should not be trading those things, but they're trying to make a quick buck. So do you think passive investing and ETFs or exchange traded funds are in a bubble in terms of the assets under management and their popularity?
Absolutely, I do. I mean, the first point I would make, though, is this trend towards lowering your costs is really important. It's a really good trend, and that's a good thing that investors are doing that. I think it's also, really good to see so much competition between, Vanguard and Schwab to lower costs. That is like a huge accomplishment, a huge boon to individual investors. But I do think that passive investing is definitely by far the most popular strategy of this bull market, which is one of the biggest bull markets in history. And whenever you look at what's the most popular strategy during a bull market, that strategy is usually hammered pretty hard in the following bear market. And when I look at past bubbles, I think this current equity market is without a doubt a bubble. When you look at whatever it is, the Buffett yardstick, market cap to GDP, we're essentially as high as we were in March of 2000. So I think it's hard to deny that it's a bubble. But when you look at, other strategies, think about the real estate bubble and what was it? It was speculating in real estate, house flipping, these kinds of things that became pretty popular then. Or in the dot-com mania, it was day trading. People famously quit their jobs to day trade. But I think passive investing today in this market is probably even more popular among investors than house flipping was during the real estate bubble or day trading was during the dot-com mania. And this is why the valuations, I think, are so pervasively overvalued in the markets, because money has flowed into the indexes it's completely price insensitive, right? It's just, I'll buy the indexes regardless of price. And, as long as I hold forever, I'll be okay. And that's kind of the mindset behind it. But when you have the money flowing just into the indexes, it flows into everything. And so, when you look at a metric like the median price to sales ratio on the S&P 500, it's like 50% higher than it was in 2000, which shows you just how pervasive the overvaluation is today. And I do think that there's, without a doubt, it's being driven by these passive flows, which are, they're rationalized as this is a valid investment strategy, but it's really just performance chasing at the end of the day.
So correct me if I'm wrong on a couple points here. In my opinion, capitalism and free markets are supposed to be naturally deflationary. So the more competition there is, that's good for consumers, and that's supposed to drive prices down. So if we're getting competition there for money management over the long term, that's going to be good for consumers. People manage money, less fees are being extracted from them, more profits to be reinvested. But the other thing is, with the S&P 500 and these other indices, a lot of the companies that make up these indices, Jesse, are not killing, they're not guiding higher, they're not beating revenues, they're not killing earnings, they're not growing free cash flow. It really just seems to be a lot of the gains in the indices, at least the Nasdaq and the S&P 500 seem to be from basically Amazon and a handful of other technology companies.
Yeah, I think, those big companies do skew a lot of the metrics that people look at. So, you look at corporate leverage, and people say, well, it doesn't look too bad on the surface, and that's because a handful of these technology companies have a ton of cash. But when you look at, again, like a median, I think that's why it's important to look at median metrics. It tells you not just what the biggest companies look like, but what the average, the middle of the road company looks like. And when you look at median, corporate leverage, it's off the charts. It's higher than it's ever been. And so, yeah, I do think these companies are skewing a lot of the, growth numbers, and earnings and all those kinds of things. And, there's always it was the four horsemen during the dot-com mania, and now it's the FANG stocks. And, there's always those most favorite stocks that lead the bull market. And as Howard Marks, said this week, that it's usually those most popular stocks that are ones that are hit the hardest in the coming downturn. So.
Yeah, and there's been, over $4 trillion in share buybacks, a lot of it with debt, not free cash flow, since 2008. So taking advantage of those artificially cheap interest rates from central banks. And in the comment section of a lot of my videos now, it's been this way now for months, whether I cover gold or any other topics, it just says, shut up, don't talk about this topic anymore, just buy stocks, buy the dip, it's going higher. So there seems to be an attitude from people on Main Street and non-financial professionals that they can do well in investing simply by buying index funds, and that professional money managers are no longer needed. So as someone who worked in the financial industry, that's a red flag to me, because that seems to be kind of that same mindset that we had with cryptocurrencies only about 8 months ago, late 2017, early 2018, before that crash, gold, silver in 2010 and 11 before that crashed, etc.
Right. Yeah, and I think really what that mindset is coming from is, I mean, there's been so much money printing that it's really, the markets have gone, straight up. And even as the Fed has, started to tighten liquidity, we still have had extremely loose monetary policy and money printing in Japan and Europe. And so, over the last 5 years, there's been a ton of money from Europe and Japan that's flowed into our markets looking for any type of nominal positive yield. But I think what investors, and that's really, that's the last 5 years, that's the rearview mirror, and that's why investors, they look at that and go, well, it has to just inevitably continue. But I think what maybe they're overlooking is the fact that the ECB and the Bank of Japan are going to have to play catch up to the Fed and start tightening policy also. And they're already, Bank of Japan has already started reducing its balance sheet. It's had to do less in order to pin the interest rate, where they want it. And the ECB is, continuing to make noises along, the lines of, okay, we're going to have to start reining some of this stuff in. So global central bank liquidity is contracting, or will be contracting on the whole very soon. And one of my favorite Stan Druckenmiller quotes, I'll just paraphrase him, is, it's not earnings, that move the markets. It's liquidity. Watch the central banks, the providers of liquidity, because that's what drives the markets. And right now we're seeing a global contraction of liquidity, and that has implications for risk assets.
And things may even be slowing down in China. And really, the last 10 years, in the Chinese economy, there's been more credit created there basically than anywhere else in world history. Over $35 trillion in credit now in the Chinese markets. And I think a lot of that has leaked into general U.S. stocks, into key real estate in different cities. I think there's been a lot of people have not understood how much Chinese money has leaked out of that country and into, other key asset markets.
Right. Yeah, and the China situation is pretty interesting because they're kind of tapping the brakes right now, or they have been for a little while. And I've heard an interesting thesis in this regard that I think is that 2021 is the 100th anniversary of the Communist Party in China, and they want a huge celebration supported by economic prosperity going into that. And so right now they want to slow the economy down, so that leading into that 2021, they could ramp it back up again. But yeah, I mean, absolutely, China is the world's growth engine, and so China's slowing today. We're seeing it in South Korean exports and tons of other things that suggest that Laxman Acheson has been all over this slowing economic trend for a while now, pointing to here in the U.S. Slowing real consumer spending and real incomes. And so while we're seeing inflationary pressures, that's starting to pinch the consumer here. And if the consumer here slows, in addition to China slowing, that is cause for global recession.
And I think President Trump is very worried about inflation because he's tweeted at least 3 times in the last month or so about oil and gasoline prices too high. He's trying to get OPEC and the Saudis to increase supply, because I think he knows that one of the first places that inflation will show up, especially for his voting base, will be in the oil and gasoline market. So those consumers with their discretionary income will get pinched. So I think there's at least some anecdotal evidence that inflation is really starting to pick up, like you said.
Yeah, I'm seeing a ton of it. I mean, when you look at the wage pressures, especially, my friend Eric Cinnamon tracks this really, really closely. He goes through at least 300 conference calls every quarter. And he's been talking about this for a few quarters now, that he's just, companies are saying the global inflationary pressures they're feeling are the greatest in at least 2 decades. And that's just starting to show up in the major numbers. But I mean, you look at trucking, you look at all these different things. There's huge wage pressures that are building right now with the, unemployment rate so low, and the tax cuts kind of, goosed, inflationary pressures also. So yeah, I think there's a lot of, I think this, and we're also hearing it from the Fed, that they're seeing this stuff and going, okay, yeah, we have to just keep on this rate hike path right now, because as much as we don't want to burst this bubble, we have to make sure we, don't get too far behind the curve.
I've been saying this for years now, that I think one of the major effects of all the central bank intervention will be, and now we're adding trade wars to this too, and that's going to force higher costs in the supply chain as well, will be a lot worse stagflation in the global supply chain with the central bank intervention. And that's probably a best case scenario.
Yeah, I mean, Alan Greenspan has come out in the last few months and said we are headed to stagflation right now. And so it's like, the writing is on the wall that if without the tax cuts, the economy would be, pretty poor right now. In fact, bank earnings, the only reason they had any growth this last quarter was because of the tax cuts. And, we are a credit-driven society. And so, yeah, I think definitely the economy is slowing as inflationary pressures pick up. Stagflation, it's probably too soon to use that term now, but it certainly looked like we're headed in that direction to me.
So as someone who focuses on fundamentals and value investing in their approach to investing and allocating capital, are you surprised by how many years the value investing methodology has been underperforming for?
No, I'm not surprised by it. I have a few different thoughts about it. One is that in an environment which is, I believe, the most pervasively overvalued equity market of all time, that I don't know how you could assume that value wouldn't underperform in that environment. So it's a lot of it is just the fact that so much is so overvalued that it's really hard to find value anywhere. But I also think, measuring value's performance is also very difficult to do, because I believe that, value-based indexes are not, are probably also being, they're also a part of this passive bubble. Right, so money is flowing into these indexes, and they're flowing into value indexes too. So there's a mania in passive investing that doesn't omit the value factor from that mania. In my experience, though, I have found incredible value, and so for that reason, also I don't really feel like a value index is true value, because true value is really, kind of the areas of the market that go overlooked and that are out of favor. And it's hard to say that anything tied to an index has been out of favor in the last few years. So where do you find actual value in the markets? Where I've been finding it is in the things that are really outside the purview of the indexes. And this gets a little bit into the construction of the indexes, which a lot of people just think they're market cap weighted, but they're actually not. They're float adjusted market cap. So when you have companies that have very low float or very high insider ownership, they are underweighted by the index. So they're basically just ranked on the market cap that's available to the public. And so you have these companies with super high insider ownership that literally just can't be owned by the indexes. And if you look over long periods of time, the companies that you've wanted to own are the ones with high insider ownership, right? These are owner-operators. They operate the business as owners, just the way shareholders would want them operated, as opposed to companies that have little or no insider ownership, and the executives are running them as, their piggy banks. Like you mentioned, a lot of times they're borrowing money to buy back stock just so that there's somebody to inflate the prices so they can sell their options, and all these kinds of things. So I found terrific value in the last few years during the midst of this mania in areas outside of the indexes, and those are usually companies that have high insider ownership and high insider buying at the same time.
So do you think then that value investors don't pay enough attention to the global macro picture, and that's why some of them are going to continue to outperform, or do you think that it's just smart as value investors to be disciplined, to stick to their methodology. And I know a lot of value investors are in cash right now. Some have a gold position, but a lot of them have very large cash positions and have, are starting to put on some shorts.
Yeah, I think what value investors should do is really think about what really is value. Value, I don't think of it as being a factor. I don't think I want to just buy cheap price-to-earnings ratio stocks, because a lot of those companies are crap companies, and I don't want to own them. So what is value? And I think really that's what there is no substitute for thinking about business, thinking deeply about individual companies, about the sustainability of their business models, and these types of things. And I think that's a lost art today. I think that even value investors, who call themselves value investors, are usually just investing based on a factor rather than actually thinking about business, or even thinking about how that factor might evolve over time. And so, honestly, my feeling about it is value investors, generally just need to go back to what value originally was, Ben Graham, Warren Buffett, and thinking about business.
And I also think, to add to your point, Sarah, that if you just look at price to earnings, you're not doing a good job, because earnings are so manipulated now, whether it's the share buybacks, like you said, with the artificially cheap debt, or the tons of other different ways that the CFO can do financial engineering. I mean, there's a financial engineering group on LinkedIn where they have conferences every couple months for new ways to come up with financial engineering now. I guess it's technically legal in a gray area or whatever, but this is the new normal that we're in. So you can't really rely on just price to earnings ratios anymore.
Absolutely, absolutely, and you really, I really discourage people from doing that, anyways, because I see a lot of value investors, looking at a company like Micron, which looks really cheap on a price-to-earnings basis or any type of other earnings metric, but this is, probably one of the most cyclical companies and one of the most cyclical industries on the planet, and these cyclicals always look cheap at the top and look extremely expensive on the bottom. And so, yes, thinking about the cycle is extremely important rather than just relying on a single valuation metric.
Okay, so let's transition now to the rest of 2018, since we're more than halfway done with the year. What do you think are the most important things that people should pay attention to for the rest of this year? Is it the oil price maybe gets too high, maybe gets too low and hurts the oil producers? Does it have to stay in a trading range for the global economy to not be drastically affected? Is it the dollar index rally that we're having right now? The dollar index rally, we're recording this show on Thursday, July 19th. The dollar index is holding up above 95, the overhead resistance level, and President Trump is already complaining about it, saying the dollar is too strong, complaining about interest rate increases. Is it the Federal Reserve's quantitative tightening program that's going to ramp up to October? What do you think are the most important things that people should pay attention to then, if it's either what I mentioned or other things?
Yeah, I really think, we kind of touched on it earlier. The most important thing to pay attention to is the activity among the global central banks. And it really relates to what inflation is doing. I personally believe they're all behind the curve already, including the Fed. I mean, if you look at, people are talking about, well, the yield curve's not inverted yet. Well, if the Fed funds rate were where it should be, based on past cycles, which is we still have a negative Fed funds rate to the tune of like 100 basis points. So technically, Fed policy is still easy. And, like you said, Trump is complaining that they're raising interest rates. Well, they're still, 100 basis points below the inflation rate currently. And, 200 basis points or whatever below GDP. So, and so, I think they, these inflationary forces are still picking up steam. And with the unemployment rate as low as it is, there's going to be more and more pressure on wages, the tax cuts. The administration is talking about even more tax cuts down the road, and the trade wars and other inflationary thing. I think there's a ton of inflationary pressures building, and all of the central banks are already behind the curve. So, and they're going to be faced with the decision of either allowing inflation to run hot, right, which is a dangerous game to play, or starting to raise rates pretty rapidly and maintaining quantitative tightening, and that will threaten the bubble in both stocks and bonds, that we and real estate that we currently see today. So it's not a fun choice for the central banks. It's do we blow up this? Do we risk unwinding this asset bubble that we created in the effort of trying to fight inflation, or do we let inflation start to get out of hand? And I think that's what investors need to pay attention to, because either way, there's going to be major implications for financial assets.
And I think, Jesse, starting in 2008, the central bankers basically made a choice of, do we allow a worse crash to continue, or do we delay it as long as possible? And I think they chose to delay it as long as possible and pretend that there was going to be a real recovery in the economy, and that hope that things would get better, basically hopium, with the green shoots and things like that. And so if someone believes in like the Austrian School of Economics, I mean, there was tens of trillions of monetary inflation that went into the system. And a lot of that monetary inflation, it didn't hit the real economy necessarily, although if you're, for real estate it did, but it mostly just went into asset prices. Very interesting comments though recently from Ben Bernanke saying that a flattening yield curve doesn't really matter. Did you see the David Rosenberg comments calling Bernanke out on Twitter? Pretty savage stuff.
Yeah, it's so, there's I think it's a Danny Kahneman quote, that politicians and other people in power have understood for a long time the power of suggestion, essentially. The more you repeat something over and over, an untruth, the more people believe it, and you can actually kind of try and create reality by getting people to believe. So, and I think the Fed knows this, and that they can create narratives that take hold. I just recently spoke with Ben Hunt on my podcast, and the example he brought up was Draghi and doing whatever it takes to support the Eurozone. And people believe them when they say those things. And so I think really a lot of the times those comments just come from a place of, we have to say this in order to try and to make it a reality. I don't think they necessarily believe it. Jeff Gundlach in Barron's last weekend too said, everybody's dismissing the yield curve as a red flag. But in fact, with rates being so low, the current message from the yield curve should be even more significant, more of a red flag than historically. And like I said, if the Fed was actually, let's imagine if the Fed was 200 basis points above the inflation rate today, which is kind of usually where they get in a tightening path, and we're talking 5%, 4 or 5% on Fed funds versus 2.8% on the 10-year. You're talking about a massive inversion. And so, you could argue that the yield curve, under normal circumstances would already be massively inverted.
And when Ben Bernanke makes these comments, yes, the mainstream media did give Ben Bernanke some type of award. I think it was Time Magazine saying he saved us from the abyss. But the Federal Reserve has an extremely poor track record of its predictions. And Ben Bernanke, going back and watch the videos of his comments prior to the 2008 financial crisis, saying subprime was contained, there was no housing bubble, et cetera, et cetera. So, I mean, I guess people have a short memory now because everyone's so ADD with the social media that, you just got to go back and look at people's track records. And for Ben Bernanke to be, blowing off the yield curve and saying it doesn't really mean anything, look at the man's track record. He just doesn't have a good track record of making predictions like that.
Yeah, and I think people just underestimate the Fed's desire to try and use the power of suggestion, and not just Fed, but former Fed officials and everybody, is that, hey, if we put this out there, people will believe us, and then, it's sort of like, trying to create the wealth effect, that if we make people feel wealthy through financial assets and real estate prices, that they'll go spend more money. And so, I mean, the Fed, this is exactly how the Fed thinks. If we tell them X, Y, or Z, then maybe people will feel that way and things will be all right. And so it's not a matter of them believing it, but then trying to get us to believe it.
They call that, I think in the self-help books, they call this speaking it into existence.
Yes. Yeah. Yeah. Who is it? Stuart Smalley, who's a SNL character. Yeah. Basically, yeah. Positive daily affirmations. That's basically what the Fed's doing, for sure.
So the central bankers, and your opinion is with the Fed, the European Central Bank, the Bank of Japan, the Bank of England, they're actually willing to prick the everything bubble in the near future then?
I don't know. That's a question that it will be interesting to see what happens, because the part of this also relates to the independence of the Fed. Trump came out this week and said he's not happy with rising interest rates, and the last time a president put that kind of pressure on the Fed, it resulted in a runaway inflation. And so I think Powell has said, I'm going to maintain the independence of the Fed, will not be pressured, and he has mentioned recently a lot of times, financial stability is something he pays very close attention to. So I think trying to balance all those things, I think he realizes that I do think he realizes the risk of letting inflation get out of control is a bigger risk than trying to prick the financial bubbles that are out there, because both, if inflation gets out of hand or runs hot and interest rates, go up a ton, that's going to prick the financial bubbles anyways, right? I mean, that means bond values are going way down and discount rates on stocks are going, way up. And so, that puts pressure on equity prices. And so I think that they realize that, they might be just backed into a corner and they're not able to save it either way. But it'll be interesting to see how quickly, they can, or how much they continue to raise rates. I think they will continue raising, simply because you look at things like the Fed's underlying inflation gauge, and it's pointing straight up right now, which means CPI is going to just keep going up over the next few months. And so, we could get 2 more rate hikes, before the end of the year. And so I do think it's hard to know whether they're going, if they're willing to really get tough on inflation, but I think it just depends on how much inflation keeps going higher. I see it right now as a very powerful trend that's going to force them to keep raising.
I think central bankers, a lot of them, especially ones here in the United States, have an pro-inflation bias. They prefer inflation over deflation if they have to pick one. So when you said that a president bullied a Federal Reserve chairman into not raising interest rates, are you referring to President Nixon and former Fed Chairman Arthur Burns?
Yeah, and so back in the, so there's and that was really the last time where we had a battle between fiscal and monetary dominance. And so, I think we're seeing a replay of that time where, for the past however long, 20 years or something, we've had a fiscal, authority that's, been relatively tame. Yes, we've had some big expensive wars and things, but, debts and deficits haven't gotten, totally out of control. But now we have this huge tax cut in the middle of an economic expansion, and we have the deficit widening significantly. I mean, I think the White House just came out and said, deficit next year is going to be over $1 trillion and push over 5% of GDP. This is during an economic expansion, which is really, really unusual. And so this is, the fiscal authority is getting pretty wild. And it puts the Fed in a very difficult position because we're already late cycle. We already have inflationary pressures picking up, and now the fiscal authority is challenging them directly. And so, the textbooks say this is where the Fed really has to get tough on inflation, because if they don't, it can run away from them. And so I think that's where we're at, and I think that the Fed is going to have to put its own agenda on the back burner and essentially deal with the inflationary implications of what the fiscal authority is up to right now. I mean, if there's another tax cut coming, like Larry Kudlow said, and we have the trade war stuff really, starts creating more inflation, the Fed's going to be in a very difficult position. They're not going to be able to protect the everything bubble. They're going to have to raise. And so, I do think really the best way to describe it is a battle between fiscal and monetary dominance.
And if Trump does get that other tax cut and, these tariffs are viewed as positive by his voter base, that may get him re-election, but then that could potentially make him Herbert Hoover in history.
Yeah.
So I know you've been in markets longer than me. Would you say then that normally a lot of financial crises last only about 6 to 12 months with a massive amount of pain before the politicians, the central bankers, the other economic and political elites start to say, you know what, we can't allow this to go on for that much longer without, massive amounts of intervention, rules changes, QE. Obviously, there was Smoot-Hawley. President FDR did a lot of other crazy things in the 10 years that prolonged the Great Depression. Would you say then that normally it's about a 6 to 12 month pain point then?
I don't know. Everything's different. I do think that's what investors are counting on, that, okay, well, maybe we'll get another bear market, but then the Fed will ride to the rescue again and, bail whoever needs bailing out and, print money to pump up asset prices again. I do think, there's a big risk of, like I just said, inflation preventing them from doing that. And, there's also, I always think about, what's the most popular strategy of the day, and it's passive investing today. And one of the, the definitions of a bubble, at least the way George Soros defined it, was there's a false assumption or false belief behind the bubble. And I think the false assumption behind passive investing or false belief is that, they believe so long as I have a 20-year time frame, I'll never lose money in the stock market. And this is very, very similar to the belief during the real estate bubble that was, real estate prices have never declined on a nationwide basis. Speaking of Ben Bernanke, I think, he said that in 2007. Real estate prices have never, declined on a nationwide basis in our country's history, which was untrue. But then as soon as he said that, it happened. And so I think investors are counting on, as long as I have a 20-year time horizon, I'll always be made whole in the stock market. But if you were to say that to Japanese investors, they would laugh you out of the room. You look at the 1990 peak in the Nikkei, and prices are still, I don't know, a third below that peak from 28 years ago. And if you look at from the 29 peak, it took till 1954 to be made whole. And then if you look in real terms, inflation adjusted, there's been plenty of times there's been 3 decades to break even. And so that's what I worry about this cycle. I mean, I honestly don't know how this stuff's going to play out, but I worry that, in every bubble, it breaks that false view. It proves that view is false. And so I'm just worried that that belief that investors are confident that they're going to be made whole and over any 20-year period will be proven false during this next cycle.
So do you think that the 2 largest economic landmines now that the market is worried about the most, and maybe this is showing up with the stronger dollar, with how emerging market currencies have not done as well for most of the year against the U.S. dollar in the short term, are European banks and emerging markets?
Yeah, I think usually what is the most, pressing risk to markets is the thing that people aren't paying attention to. And so people are paying attention. There's a lot of talk about emerging markets and stuff right now, and there's been a lot of talk about China for years. I really don't think that, leading into this, communist anniversary, it's a completely controlled, economy. And so, they can do whatever they want. It's like the fiscal authority, there's no battle between fiscal and monetary dominance like we have here. Yeah, they can just too. Right. They can just make whatever they want happen, and speaking of the power of suggestion, they can put out whatever numbers they want to give their populace confidence too. And so I think it's China over the next few years is definitely slowing now, but I don't think there's a huge risk of a blow up. Now I'm not a China expert, but that's just my opinion from watching it from the sidelines. I think the biggest risk to markets today is something that's probably underappreciated, or something that's just blown off by investors, and that could be, inflation. It also could be another thing that I've been tracking for the past year, which is this backlash against big tech. I think people are underestimating regulators, especially in Europe, but here at home too, willingness to clamp down on these companies. Something that went totally unnoticed last week was the FTC hired the woman who wrote this paper about Amazon for the Yale Law Review a couple of years ago. It was basically, antitrust policy needs a rethink, and this paper went viral. And they just hired this woman at the FTC. So, and then you have the UK finding Facebook criminally liable for the Cambridge Analytica scandal. Yes, they didn't charge her much money, but there was, however many Americans that were affected by it. And the FTC fine is $40,000 per user that was affected. So that's still an open case here in the United States, and I think investors don't appreciate the risks to these big tech stocks.
That's very interesting. I think the European Central Bank, one of the reasons they started QE is that they've basically been secretly, covertly bailing out a lot of the European banks for a while now. There was a lot of, everyone knows the problems with Deutsche Bank, but there was a lot of other problems with Italian banks, with Spanish banks for at least the last couple years. And so we haven't seen the bankruptcies. Some banks have been nationalized, but I think one of the major reasons the ECB did start the QE program was because it was basically a covert bank bailout. Actually, I don't know if did you read Ray Dalio's book, Principles?
I didn't read the book yet. I did watch his videos. Those are pretty cool, actually.
Yeah, I'm almost done with his audiobook, and he's got some interesting, juicy tidbits in there. I mean, he disclosed he had some private meetings with Ben Bernanke and Janet Yellen. He also flew to Europe and had a private meeting with Mario Draghi. He was launching, he was promoting his beautiful deleveraging paper in the U.S., but a couple years after that, he flew to Europe and he demanded, because he was worried about deflation there, that they start QE. So he was like one of the main lobbyists there to get Draghi to do QE back then. It was an interesting tidbit from the book there about Dalio that he disclosed.
Yeah, he's an interesting guy. I'm a big fan of his work and stuff. I have to check it out.
So are there any specific sectors or industries where you think people should research where there's good values, maybe undervalued growth then? Because obviously if you said people just look at PE ratios, it could be a value trap. So are there any undervalued growth industries you think that people maybe over the long term should look at or do research on, or maybe wait in case there's a market crash that would be a good idea maybe to buy after there was a stock market correction or crash?
Yeah, my process is usually company specific rather than kind of sector wide or even macro. But that said, the one area that just smacks to me as being obviously undervalued is, real assets relative to financial assets. Part of that's because financial assets are so extremely expensive, but also commodities are extremely cheap, and I throw precious metals into that also. So I do think the one place that is definitely out of favor right now and is, fundamentally very cheap are, real assets, but most especially commodities and precious metals.
Oh yeah, if you take a look at the comment section after this video gets released, because we said anything positive about gold and silver, there's going to be really, really negative comments there. So as a contrarian indicator, you look at sentiment, and we've seen some of the sentiment surveys. A lot of professionals are bearish, but retail, especially in the United States and Canada, is extremely bearish on precious metals right now.
Yeah, and I think this sell-off over the last couple of months is really a gift to those of us who are longer-term bullish on the gold price. It's really just a 10% correction in a bull market, the way I see it. But the way everyone else sees it is, oh my God, gold is. I'm seeing people toss around, gold is just a rock, it's worthless, all that kind of stuff again, which is exactly the kind of exactly the kind of sentiment that you want to see, when it's time to buy.
Well, at a certain point, the miners I did a short video on this recently. The miners have had a bear market basically for 7 years since 2011. They were slow. They were way behind the curve at cutting costs. They did a lot of bad acquisitions. John Paulson said they wrote off, according to his research, over $80 billion in bad deals. So you would think then that their balance sheets would be lean and mean, but, they're still struggling to maintain margins now because oil prices are starting to rise. So their costs are going back up. So you have kind of... this is not sustainable, though, because the metals still need in the real world. There's still strong demand for gold and silver out of China and India and the Russian Central Bank and Chinese ETFs. So, although in the West people aren't buying gold and silver, people in the East are.
Yeah, no, I am very, I do pay pretty close attention to the miners, but again, I don't own them as a group. I don't want to own really anything as a group. I'm very selective, and there are some miners, and this is what really first attracted to me and to a couple of them in 2015. Is when you look at a stock that's trading at 50% of its tangible book value, to me that gets me very excited, because in this market it's almost impossible to find anything that comes close to that cheap. And so that demonstrates to me that there is great value there, but you have to. You're right. Some of the balance sheets aren't pretty, and you have to be very selective.
And there's also, I think, compared to other industries, there's actually real insider buying in some of the gold miners. So not every gold miner, but some of them like Barrick Gold and some of the others. I interviewed Fred Hickey on this last month, and he was talking about a number of the gold mining stocks where there's just massive amounts of insider buying, which is pretty rare nowadays.
Yeah, and that's something that I watch really closely too. I mean, and buying is usually more predictive than selling. But especially when you see some of these guys, and I look at executives more than directors and things, but when you see executives spending, 2-3 times their annual salary in shares, to me that's a really good sign. And you're right, you can see that in some of these mining stocks. So you get one that's cheap with a good balance sheet and some insider buying, and to me, yes, that's a wonderful opportunity currently that it's really hard to find anywhere else.
And unfortunately, I don't think we're seeing a lot of these mining companies, take advantage of the low prices where they're going to go do acquisitions and be aggressive and buy at the bottom, buy quality assets for pennies. We're not really seeing that. But for the larger 5 precious metals royalty and streaming companies, we're seeing just massive amounts of deals from the larger companies taking advantage of the low prices that we've had lately. So I think the valuations on those are higher, but you're buying quality. You don't have to worry about margin compression like you would with the gold miners and silver miners.
Yeah, that's a good sign. And I also see that the gold mining shares as a group have been really outperforming the metal during this last sell-off, which to me suggests that there could be some, significant accumulation going on in the gold mining stocks amid all of this bearishness, which would be another good sign.
And if you talk to a lot of gold mining CEOs, they think like most of the fat of the industry has been cut, and the balance sheets of a lot of the companies are lean and mean compared to the past, and that they expect over the next couple of years higher metals prices. So in the short term, almost anything can happen with these high-frequency trading machines. Gold right now, I think, is at like 12.22, and silver's barely holding 15 when we're recording this. But at some point, there's going to be a big rally, I would expect.
Yeah, I'm bullish over a longer-term time frame. Like I said, I started buying a couple of miners in middle of 2015, and it did get painful towards the end of that year in early 16, but then they really took off in early 16, and it's kind of just gone sideways to down since then. But yeah, I mean, I think if you have a 2, 3, 4, 5 year time frame in these things, they really presented a very interesting risk-reward setup.
Do you think most of the headwinds for the gold price has been the dollar index rally, or do you think it's that a lot of investors like Mark Dow and others just don't want anything to do with gold?
Yeah, I think there's a lot of excitement about the dollar right now, a lot of euphoria towards the dollar, which, to me, I just see it as a bear market rally in the dollar right now. But when, you look at the managed money position in gold, it's, back to nothing, essentially. There's, they don't own any anymore. It's as low as it was back in that 2016 or 2015 bottom. But then you also look at look at all the futures positioning and all the dollar crosses, and everybody's bulled up on the dollar again versus almost every other currency. And to me, that's all that's going on right now. Is for some reason the perhaps due to the trade war stuff, people are thinking this is bullish for the dollar. But it was I think it was. Cow came out with a report recently, and I agree with it entirely. I tweeted their post and said that when Trump is essentially pursuing this trade war and giving the world the finger, it's hard to make a bullish case for the dollar and longer term. And then when you have deficit blowing out to over $1 trillion next year, 5% of GDP, there's some big time fundamental factors that are bearish for the dollar over the longer term right now.
Yeah, I agree. I think this is probably a bear market rally for the US dollar, but it could signal if the dollar continues to strengthen, maybe it gets past the overhead resistance levels at 97 or 100 or 102. If it gets past, 100 or 102, I think it's going to potentially signal that there is major problems with the dollar strengthening, and also the dollar denominated debt maybe in emerging markets or elsewhere. So I don't think we're there yet, but in the near future, if the dollar continues to rally, I think that could happen. But I think President Trump and his Treasury Secretary have made things clear that they don't want a strong dollar. So we don't know what type of intervention policy that they can do. Either they did this in 1985 with the Plaza Accord when the dollar was getting too strong. There's ways that they can step in through either open market operations or like a large agreement like the Plaza Accord if the dollar is getting too strong.
Yeah, and I think that it makes a lot of sense to look at all these things in concert with one another. So so people are thinking about the trade war, but there's also been currency wars going on for a long time, and I think that's what's going on right now with the Chinese yuan is they're using the currency to kind of retaliate against a lot of the tariffs and stuff. And then there's, like Steve Bannon said this week, we're already at war with China, maybe not, like in a physical traditional war, but, in terms of, corporate and economic superiority, China's doing everything in its power to get an economic advantage and a technological advantage. And so all of these things kind of, work together in concert, and I think that, yes, the administration sees that part of this is a currency war, and we're not going to just let the dollar, run through the roof, because that would essentially be admitting, defeat in that area, in that one part of the overall war. So, yeah.
And I also think that the U.S. and China are in a cyber war. So there's, hacking back and forth with each government. Obviously, like the U.S., the mainstream media here is talking about the Russians. There's cyber wars with a lot of different governments. So there's a huge cyber war. It's a bull market right now in hacking and cybersecurity.
Yeah, I mean, whoever owns the hardware advantage, who owns AI and quantum computing, whoever owns the data race to, collect and figure out how to best manipulate, data and surveillance, and this is going to own the future, is going to own the world. And so, yeah, there's like you said, there's that cyber warfare, there's a data race, there's a technology race. China, insists they want 40% of semiconductors made in China by 2025, and in order to do that, they're going to have to put out a lot of other semiconductor companies essentially out of business or commoditize a lot of those businesses. And so, yeah, there's on a lot of different levels. There's a lot, and they're all different skirmishes within this larger economic war. I think that's already underway.
So I've kept you for over 50 minutes. I don't want to take too much of your time. I got one last question. So what do you think about the warnings that Jeremy Grantham, Mark Mobius, Paul Tudor Jones, Stanley Druckenmiller, a couple other money managers have been giving about an upcoming U.S. stock market crash in the near future? Do you think that they were more willing to speak out because they have enough money now and don't need to worry about losing their job and the ability to provide for their families, rather than someone who is managing money and speaking out?
Yeah, I think there's a lot of businesses right now today. This is something I've thought about writing about, because there's a lot of businesses today that are just kind of like, let's make money, let's make hay while the sun's shining, and we can make a ton of money so long as the bull market lasts by just putting people in passive funds or by just selling volatility. We know it's going to go wrong someday, but we can make a ton of money in the meantime. And, I don't think very highly of those, people pursuing those business models, but they're out there, and they're out there during every market cycle. It could be selling naked put options. It's going to make a ton of money for a certain amount of time but it inevitably blows up. And I think these guys who are saying these, warnings, Carl Icahn was another one who came out a couple years ago and produced his whole danger ahead video, which has, been mocked, even though I think it's very admirable for these guys to they don't have to come out and say this stuff, even if they believe it. they could just be quiet and profit from it. But I do feel like, especially in the case of Carl Icahn and Paul Tudor Jones, these guys do care about what happens to the average investor, and they feel like they're privy to much more knowledge and a much greater deal of expertise than the average investor. And if they can help a few people avoid another painful crash, then they can. That helps them sleep at night. And so I think that's it's really just an admirable thing, because they have no other reason to speak out on those things than to try and help people.
So when you were professionally managing money, you had to be more political and careful, more diplomatic with your answers, and you felt like if you spoke out, you risked people pulling their funds, or, I don't know, threatening to take away their money or remove you from your position then? Do you think that's prevalent in the money management business now, where a lot of people realize what's really going on, they can't speak out?
Well, yeah, I think it depends on your business model, right? I mean, if you're, Paul Tudor Jones and David Einhorn's been talking about bubbles for a while. I mean, these guys run long, short portfolios. And so, they're saying, I want to make money in any environment, and I see an opportunity in the future to make money on the short side. Most people can't take advantage of that. And so they're basically just talking, about this is why I do what I do, and these are the opportunities that I see. Now, I do think there are a ton of companies out there, or long-only managers, or things that are that do see these risks, and they do know that they do believe that there's going to be another painful episode at some point in the future. But that's, to speak about that would, hurt their profits in the short run. And so I think for them, it's more about protecting their short-term profits than anything else.
That's interesting. Yeah, I was surprised to learn. I learned this from Real Vision TV, from Raoul Pal and Grant Williams. And I know you've had Grant on your show. That's an excellent interview for our listeners on your podcast with Grant Williams, that there was leverage short volatility trades in not just the stock market, like Christopher Cole of Artemis Capital has pointed out on the VIX, but also, stock market in the VIX, but also in many different markets. So that surprised me that this has been going on, and it's pervasive now in many different asset classes.
Well, yeah, I mean, it's not just in asset classes too. It's like, retail investors got into selling catastrophe insurance. Let's buy essentially catastrophe bonds, which is you're essentially selling catastrophe insurance, and that's just another, basically a short volatility trade. And so it's being expressed in a variety of different ways. I think the most recent one that I saw were these FANG structured notes that are coming out, which is essentially, Credit Suisse will give you a 20%, a bond that pays a 20% coupon, so long as the FANG stocks don't go down more than 30%. And the way they fund that is by selling put options, essentially selling naked put options against the FANG stocks, which is, it's same deal. It's the same exact thing that blew up the XIV, or at least a very, very similar, thing that blew up XIV. And so, yeah, this same trade is being expressed in so many different ways that it makes a high volatility, crash-prone environment inevitable.
Is there like an EIG out there with this trade? Do they not have they don't have the reserves then to cover any of the losses, and they're betting that they won't lose on the trade?
No, so basically that structured product can be wiped out completely, and that's just what would happen. So just like XIV was wiped out essentially in one day, these FANG structured notes also say that yes, if these stocks go down by X amount, the product will go to zero. So this is just another example of, yeah, we can make 20% a year for a period of time, but and it's like to think that there's going to be a time where those stocks don't go down 30%, right? It's just another example of this business model that I'm talking about, which we know we can make 20% a year, which sounds awesome for a period of time. But we also know that there's a very high likelihood of this thing blowing up. So yeah, it's the product that would blow up, not I don't think the provider of the product.
Oh, I see. And, they can make 20% for a number of years, for a good amount of years, and then all it takes is one time for it to blow up. But hopefully, they're retired. They've already made a ton of their money. That's like how a lot of the trades went prior to the 2008 financial crisis, right? A lot of people did make a lot of money off the fraud, and they got out.
Yeah, and there's a great John Meriwether, I think it's John Meriwether quote that relates to this. He was the founder of long-term capital management, and I'm going to bungle the quote, but he said essentially, the problem with selling insurance or selling volatility and selling any of these things is once it's made, public that you're in that position, somebody can force you out of that trade and, and essentially force you to blow up. So, that's an interesting prospect too. That was the same thing that I was just tweeting that VIX futures positioning chart month out, week after week after week when it's coming out. I'm like, man, there's a huge short volatility position. If somebody just comes in and starts buying volatility, force all these guys to cover, you're going to see a massive unwind here. And you can essentially just call their bluff and force them to blow up. And, I don't know if that's true with these FANG structured products or with any of these other trades, but it's a very interesting situation.
And I wonder if those guys are going to have to go to the Federal Reserve or the U.S. government for bailouts. Oh, God.
Right.
I hope that. Well, Jesse, I think you've provided my listeners with a great interview today. A lot of interesting, thought-provoking ideas there and information. I want to thank you again for your time. If our listeners want to follow you on Twitter, listen to your podcast, check out the Felder Report, how did they do so?
Yeah, I'm pretty active on Twitter. I share a lot of the stuff that I read there and various charts and stuff. It's just at Jesse Felder on Twitter, and then I blog pretty regularly at thefelderreport.com.
Excellent. And your podcast is available on your website, right, or on iTunes?
Yeah, that's also just super investors or search Jesse Felder, but it's available at thefelderreport.com. There's links there too.
Great. Well, I hope in the future you'd be interested in coming back on for another discussion. And I look forward to speaking with you again in the near future, and keep up the great work on your Twitter feed and also with your podcast.
Thanks, Jason. This was a blast. Appreciate you having me on.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.